Hello, candidate. I'm happy to stand before you once again so that I can answer questions from the financial management paper that was done in November 2019. So far, we have done question 1, question 2. Today, we want to answer question number 3. It's my hope you've attempted it. Question 3 is in 3 parts A, B, C. We will first answer A, which reads, using a well-labeled diagram, distinguish between systematic risk and unsystematic risk. Using a well-labeled diagram. Now, before I can demonstrate the difference between systematic risk and unsystematic risk in a diagram, I will define systematic risk. Systematic risk, candidate, also known as the diversifiable risk, and diversifiable risk is the risk that is caused by factors beyond the control of the individual investor. Okay? This is the risk that is caused by system-wide factors like the economic factors, political factors, social factors, and so on. It's not possible for the individual investor to minimize or reduce that risk because it affects all the companies in the industry. I've mentioned economic factors, political factors. When there is political unrest or in the country, or when the government has passed legislation affecting all companies in the industry, then it's not possible to diversify such risk. The economy may also be going through recession. Those are when the economy is in recession or depression, then that is an economic factor which cannot be diversified because it is a system-wide factor. And the effect of these system-wide factors is beyond the control of the individual business. Okay? And generally, the system risk is attributable to macroeconomic factors. Okay? Now, that is the meaning of systematic or undiversifiable risk, and there are many types of such risk, like the interest rate risks, the market risk, the purchasing power risk, and so on. We will now define the unsystematic risk. What is the meaning of unsystematic risk? Candidate, unsystematic risk, also known as the diversifiable risk, is a risk that is caused by specific factors which are unique to companies and differ from one company to the other, as opposed to the systematic risk, which I said is caused by system-wide factors. Unsystematic risk is a risk caused by factors which are unique to the company. For example, the business risk, which is also known as the operating risk. Operating risk arises due to the chances of variability in returns caused by a firm's pattern of usage of funds. This risk is concerned with the earnings before interest and tax, or what we call the operating profit. Another example of unsystematic risk is the financial risk. Financial risk is or arises due to the debt component in the capital structure of a company. A company with a high component of debt, meaning a highly geared firm, is considered to be more risky than a firm that is less geared. Okay, a levered firm as opposed to the unlevered firm. So that's a distinction between systematic and systematic risk in words. The question is using a well-labeled diagram. What I've done is to give the distinction in words, but I'll move to give or to demonstrate the distinction. Financial management, we are answering questions from the financial management, the paper that was done in November 2019, question 3. Question 3A, distinguish between systematic and unsystematic risk. Distinguish distinction between systematic and unsystematic risk. Systematic risk and unsystematic risk using a well-labeled diagram, and this means a graph. You are going to use a graph to distinguish the two. We'll have a graph on the y-axis. We'll have the portfolio risk, which is measured using standard deviation. Then on the horizontal axis, we're going to have the number of securities, or just portfolio. Okay, portfolio is a group of securities. Risk is represented on the y-axis, and the risk, the total risk, we know, candidates, that we know that total risk is equal to the systematic risk plus the unsystematic risk. Total risk is equal to the systematic risk plus the unsystematic risk. So this, let's say this is the total risk. Okay, this is 0 here. Standard deviation. When you add the systematic risk and systematic risk, you have the total risk. Then when an investor is holding few or one security, the risk is very high. But when the investor invests in a group of securities, then the risk reduces or is minimized. Okay, that's the point of having a portfolio, having many eggs in different baskets, as opposed to having all your eggs in one basket. So if you have many securities, then you will diversify risk. You will reduce this total risk. All right. So, and remember we've said that there is risk that can be minimized, and there is risk that cannot be minimized. All right. Systematic risks cannot be minimized because they are system-wide risks. but you can only diversify the unsystematic risk. So the graph will take this form. Will take this form. Right. So this will have the total risk. Let me draw this. This represent the total. This represent the total risk. Then we have at the point when this graph flattens, okay, flattens at this point, let's begin to flatten around this point. Beyond this point, no combination of securities will reduce the total risk. Okay? Will reduce the total risk. So this will represent the systematic risk. Systematic risk. Systematic risk. Then we'll have systematic risk up to this point. Will be up to this point. Or let me use my red pen. Let me use my red pen to demonstrate that. Use my red pen here. Red pen. Use my red pen. Use my red pen. Then I have the unsystematic risk. This will represent the unsystematic risk. The unsystematic risk. So that unsystematic risk from this point to this point, this, or from this point to that point, unsystematic risk plus systematic risk will be the total risk. Candidate, that is the diagrammatic presentation of the distinction between systematic and unsystematic risk. And you can see I've just said that from this point, systematic risk cannot be minimized. Okay, up to this point, this is the farthest this total risk can go because of the element of the systematic risk. So that will earn you 4 marks. It's a mark for indicating the number of securities on the x-axis. It's a mark for showing portfolio risk on the y-axis. There is a mark for the curve. Okay, there is a mark for distinguishing the position of this unsystematic risk and the systematic risk. So that is how to earn the 4 marks. Then, part B. An investor has presented the following information relating to forecasted returns of two securities Y and Z together with their respective probabilities. So the forecasted returns and probabilities are shown in the tables. Required, Roman 1, the standard deviation of security Y and security Z returns, 6 marks. Roman 2, the relative risk of security Y and security Z, 2 marks. Roman 3, advise the investor on which of the two securities to invest in. That is a simple question. We covered this in class. The question was also tested. So let me answer this question. So the question is, calculate standard deviation of security Y and security Z returns 6 marks. First thing, candidate, put down the formula. This is B1. B Roman 1. Formula, standard deviation. Standard deviation. The question is standard deviation of security Y. Security Y. The standard deviation for security Y will be equal to the square root of the variance of security Y. Likewise, the standard deviation of security Z is equal to the square root of the variance of security Z. So that's the formula. Start with the writing down the formula. Then you go to the question and check if the inputs are provided. We are not provided with the variance, so we have to calculate the variance first, then we get the square root of the variance for both security Y and security Z. So first we will work out the standard deviation for security Y, and we have it in form of table. We'll first have the probabilities which are given in the question. Probabilities 0.10, 0.20, 0.20, 0.35, 0.05, 0.15, 0.15. Probabilities. Then we have the forecasted returns. We have the return of Y as percentage, return of Y as a percentage, 10, 12, 8, 10, 12, 8, 15%, 14%, 9%. With that, we can now compute the expected return of security Y. Expected return of security Y, we calculate the forecasted return by probability plus expected return times probability, then we get the total here. That will give us the expected return of security Y. So we have 0.1 times 10 is 1. 0.2 times 12 is equal to 2.4. Then 0.35 times 8. 0.35 times 8 is equal to 2.8. 0.05 times 15. 0.05 times 15 is equal to 0.75. 0.15 times 14 is equal to 2.1. 0.15 times 9 is equal to 1.35. I'll then get the total of 1 plus 2.4 plus 2.8. This is 2.4 plus 2.8 plus 0.75 plus 2.1 plus 1.35. This is equal to 10.4. 10.4 is the expected return of security Y. Expected return of security Y. We want to do the variation for security Y first. Security Y first. So, and we've seen is the variance, the square root of the variance. So we will now do the variance, calculate the variance. The variance will simply be return of Y minus expected return of security Y. And how do we do it? The return of Y is 10, so that will be 10 minus expected return of security Y, which is 10.4. 10.4. Then 12 minus 10.4. 8 minus 10.4. 15 minus 10.4. 14 minus 10.4. 9 minus 10.4. This will be equal to 0.4. Then 12 minus 10.4. This is equal to 2.4. Then I have 8 minus 10.4 negative 2.4. Then 15 minus 10.4 is 4.6. 4.6. And then 14 minus 10.4 is equal to 3.6. Then 9 minus 10.4 is equal to negative 1.4. That is the variance. That is the variation, but we can now square this variance. We are going to square this variance. Okay, we square this variance. That is R Y minus expected return of Y. We square it, then multiply by the probability. That will give us now the variance we are looking for. So 0.4 squared times probability of 0.1. That will be 0.4 times, square it first. I square first. 0.4 square times 0.1 is equal to 0.016. Then 2.4 squared times 0.2 is 1.152. Then 2.4 squared again times 0.35 times 0.35 is equal to 2.016. Next 4.6. 4.6 squared times 0.05 is equal to 1.058. Next 3.6. 3.6 squared times 0.15. 0.15 is equal to 1.944. Next I have 1.4 squared times 0.15 is equal to 0.294. 0.294. Then I get the total. The total plus 1.944 plus 1.058 plus 2.16 plus 1.152 plus 0.016. The variance therefore is 6.48. So we have the variance there. That means we can now calculate the standard deviation of security Y, which is equal to the square root of variance of security Y, which is equal to the square root of variance of 6.48. The square root of 6.48, this is equal to 2.55. That's the standard deviation. In the same manner, we will calculate the standard deviation of security Z, and we have from the question the forecasted returns for security Z. This is RZ, 8%, 10%, 7%, 12%, 11%, 8%. Then we calculate the expected return for security Z. We multiply 8 times 0.1, the probability, that is 8 times 0.1, this is equal to 0.8, then 0.2 times 10 is equal to 2.0, then 7 times 0.35 is equal to 2.45. Next, 12 times 0.05 is equal to 0.60. Then 11 times 0.15 is equal to 1.65. Next, 8 times 0.15 is 1.20. That is the expected return of at different probabilities. Then we will get the total. 1.2 plus 1.65 plus 0.6 plus 2.45 plus 2.0 plus 0.8 is 8.7 is the expected return for security Z. Then we come here and get the variance. How do we get the variance? We will subtract the return of Z. Let me do it once and for all, just one table. We are going to have the return of Z minus expected return of security Z. All right, squared times the probability. So we have this return minus expected return of Z minus expected return of Z, we square, then multiply by the probability, at that point 0.1. So I'll have Z 8 minus 8.7 square times 0.1. This is equal to 0.049. Next I'll have return of Z 10% minus expected return 8.7. That is 10 minus 8.7 squared times 0.2. 0.338. Next, return of Z minus 8.7, 7 minus 8.7 square times 0.35. This is equal to 1.012. Next, 12 minus 8.7, 12 minus 8.7 square times 0.05, 0.55. This is 545. Next, 11 minus 8.7 square times 0.15, 0.794. Next, 8 minus 8.7 squared times 0.15 is equal to 0.074. Total, what's the total? The total 0.049 plus 0.338 plus 1.012 plus 0.545 plus 0.794 plus 0.074. The variance here is 2.81. Therefore, the standard deviation will be equal to the square root of the variance, 2.81, which is equal to 1.68. 1.68 is the standard deviation of security Z. Let's move on to the second part of this question, the relative risk of security Y and security Z. The relative risk of security Y and security Z candidate, that is Roman 2. Relative risk is measured by the coefficient of variation. Relative risk is measured by coefficient of variation. Coefficient of variation, CV. So we'll measure the CV of security Y and the CV of security Z. So CV of security Z, starting with Y, what is the formula? The formula is standard deviation divided by the expected return of security Y. And the coefficient of variation of security Z will be equal to the standard deviation of security Z, this is security Y, over the expected return of security Z. All these inputs, we have them in part 1. The standard deviation for security Y is 2.55 divided by the expected return of security Y is 10.4. Therefore, the CV will be equal to 2.55 divided 10.4. This is equal to 0.25. And the CV of security Z, we have the standard deviation of security Z, standard deviation 1.68. 1.68 divided by the expected return of security Z, 8.7. This will be equal to 1.68 divided by 8 or 8.7. Coefficient of variation is 0.19. 0.19. That is the answer, 2 marks. Advise the investor on which of the two securities to invest in. That is Roman 3. Advise the investor which of the two securities to invest in. Advise the investor. Number 3. Advise the investor on which security to invest in. Candidate, we know the less the coefficient of variation, the less the coefficient of variation, the less risky a security is. The less risky a security is. Therefore, the investor should invest in which security? Should invest in security Z, because at security Z's coefficient of variation is 0.9. Security Z. 0.9 is less than 0.25. That is the advice. Moving on to part C of this question, I read, Fairland Industries Limited has recently been listed on the Securities Exchange. The company has a policy of paying out gradually increasing dividend per share over the past 5 years as indicated below. There are a column for years from 2014 to 2018. There is a column for EPS, a column for DPS. Additional information, number 1. The company has recently paid the dividends for the year ended 31st December 2019, 2018. The shares are therefore quoted ex-div. Number 2, the management is considering a change in the financing policy whereby greater financing will be provided from internally generated funds. This is expected to reduce the DPS to 5 shillings in the year ending 31st December 2019. Number 3, The growth rate in EPS and DPS is expected to increase to 14% per annum from the year ending 31st December 2019. Number 4, the company's shareholders require a minimum return on investment of 16% required. Roman 1. Using the dividend growth model, determine the MPS as at 31st December 2018 prior to the change in the financing policy, 3 marks. Roman 2. The MPS as at 31st December 2018 under the new financing policy, 2 marks. Roman 3. The break-even growth rate in DPS using the MP calculated in C1 above. The break-even growth rate in dividend per share using the market price calculated in C1 above, 2 marks. 2 marks. Roman 1, using the dividend growth model, determine the market price per share as at 31st December 2018 prior to the change in the financing policy. So allow me to clean the board.